But we're at that time, and I think we're gonna kick it off with Michael Brady talking about 1031 exchange. So I let you not let I ask that you do your intro, talk about yourself, and then we can roll right into the PowerPoint. And you should have already had the permissions to do so. Here they come.
Yeah, sure. So hi guys. My name is Mike Brady, as Hutch said. Um, I am with Madison Exchange, which is a national qualified intermediary for 1031 exchanges. Just to give you a little bit about my background, I'm a practicing attorney. I've been practicing for about 25 years now, predominantly doing real estate law. A good combination of commercial, residential, um, a lot of lender work, and started doing qualified intermediary work in 2005 almost exclusively. I think I've closed about 3,000 transactions between commercial and residential real estate, and I've overseen 5,000 or so 1031 exchanges during the course of my career. So I've seen pretty much every flavor of transaction. So we're a small enough group. We're going to spend a lot of time answering questions also. For the folks, I guess if folks can either by show of hands, if you have your cameras on, or you can give me a reaction hand. Let me know how many people are familiar with 1031 exchanges. Okay, so I see about 3, and Hutch is cheating because I taught Hutch about 1031 exchanges when I was on his podcast a while back. Okay, and everybody here is a real estate investor. We have any advisors, investors? Okay, great. Let me jump into the PowerPoint, which is longer than it should be. I apologize, but let's see. Can you all see that? Somebody want to give me the pie sign? Okay, good. Let me just expand. All right. So we're going to talk about how to buy and sell real estate and pay no taxes. So this is a little bit of a misnomer because it's almost impossible to never pay taxes, right? It's eventually what we do in 1031 exchanges is we don't really eliminate the taxes, we defer them, right? We kick the can down the road. The only way to beat the taxes in a 1031 exchange is they say in life there are two things that are certain, right? Death and taxes. Well, and with 1031 exchanges, death beats taxes. So if you drop dead owning a piece of real property, your estate will get what's called a step up in cost basis and the tax disappears. Other than that, there's really no way to eliminate the taxation. You could just really defer it. So let me get into this. Hang on, I just want to adjust my screen a little bit because right now I'm only seeing half of it because where you folks are. That's a little bit better. Okay. So first, we're going to talk about capital gains taxes. I'm going to do this pretty quick. We're going to talk a little bit also about what it looks like on the horizon under some of the proposals that are out there for tax reform. And then we'll get into kind of the nuts and bolts of how 1031 exchanges work. But the capital gains taxes currently for 2021, for most taxpayers, I'm not going to read it line for line, and we'll send out the PowerPoint afterwards. Most taxpayers are going to pay long-term capital gains when they sell property. Okay, and the long-term rate kicks in if you own the property for a year and a day before you sell it. But the rate will typically be for most people either 15% or 20%, okay, of your capital gain. That's your profit. And you may or may not have an additional 3.8% net investment income tax on top of that. So the rate really for most people is between 15% and 23.8% for the federal rate. In addition, and I don't know, Hutch, have you ever had Yona here? Yona Weiss?
Yes.
Okay. So Yona probably taught you folks about depreciation and cost seg and all that good stuff. Well, if you depreciate a property, one of the things that people don't tell you, and I'm sure Yona did, is that when you sell the property, you have to pay that depreciation back. It's called depreciation recapture, and that's a maximum rate for the property portion, the real estate portion, of 25%. To the extent that you did a cost seg, it could be much higher for the personal property items. State income taxes. So I'm based in New York. So our state income tax has a maximum marginal rate of 8.82%. If you're in California, you're in the double digits. You're like 10, 11% on top of the 15 to 23.8%. Okay. And then some of the cities will also have an income tax. New York City, which is on Long Island, that's about an hour away from me. They have an additional 3.8% marginal income tax rate. So what does it look like? Well, if we had somebody who basically bought a property for $5 million and during the course of their ownership, they added $1 million of improvements, but they took depreciation of $800,000, that leaves them with a net adjusted basis of $5.2 million. That's the starting point for calculating your capital gain is your cost basis, your net adjusted basis. To determine your capital gain, you take that number and you subtract it from the price that you're selling the property at. So in this case, the investor is selling for $10 million. His basis is $5.2 million. His cost of sale is $800,000. And that's things like his brokerage commissions, his transfer taxes, if transfer taxes applies, things like that. That leaves him with a capital gain of $4 million from his $10 million sale price. Not too bad. But he doesn't get to keep $4 million, right? He's going to pay depreciation recapture or $200,000. Federal capital gain is $640,000. The net investment income tax is another $121,000. The state income taxes come to about $359,000. His city income taxes come to about $146,000. That leaves him with from his profit, his $4 million profit, he walks away with $2.5 million. Okay, so most of us probably are not, crying tears for this poor guy who's walking away at $2.5 million of profit. But if you think about it, he will have paid $1.4 million plus in taxes. And if not, that's not bad enough. That $1.4 million reduces his purchasing power as well. So if he was able to get a loan for 75% LTV, right, that would give him or cost him $5.8 million in purchasing power by paying taxes, right? So if he fully levered his $4 million profit, he would get an additional $5.8 million of purchasing power by not paying taxes as opposed to paying taxes. Okay, so that's pretty powerful. And that's why we look at 1031 exchanges. Now let's talk real quick about what the potential tax reform changes are. Well, first of all, what we're talking about is the Biden campaign talked about the plan for mobilizing American talent and heart to create a 21st century caregiving and education workforce. They initially proposed a program that cost $775 million over 10 years, and they were going to roll back unproductive and unequal tax breaks for income over $400,000. Well, does this include 1031? Well, they came out with the American Families Plan they've recently been discussing, and it absolutely does include 1031 exchanges. What would it look like? Well, they're talking about raising the long-term capital gain rate from the preferential rate. People don't realize that 20% is pretty low historically. They would put it to the upper tiers of the income tax rate so that if you had an adjusted gross income of over $1 million, you would wind up paying almost 40% in federal capital gain taxes, as opposed to 20% to 23. Well, actually, it'd be 20%. Because the 3.8% is still going to kick in on top of that to make it a top rate of over 40%, to be like 43% that you would pay federal taxes. The other alternative, what I think is more realistic, is I think the negotiation will flesh out, and what they'll actually do is do something a little bit less. I think it's not unrealistic that the rate will instead be something more like 25%, which I don't think is the end of the world. It's certainly not great, but it's better than 43.8%. They want to limit 1031 exchanges to $400,000 of gain per year. Okay. I'm sorry. Yeah. $400,000 of gain per year. So you would only be able to defer $400,000. I'm sorry. This is actually wrong. The most recent package says $500,000. So you would only be able to defer $500,000 of gain per year. Now that sounds like a lot of money. But if you're, investing and you continue to invest during the course of your career, $1 million of gain is really not that much. You may have one project that will have $1 million of gain. When I first started practicing law in 93, $1 million of gain on a residential property seemed unfathomable. But now in New York City, probably also in San Diego, And in Southern California, you probably have houses regularly selling for $1 million profit, and they probably haven't even been owned that long. We have condominium apartments in Manhattan that are selling at over $1 million of gain. So it's not unusual to see that. They're also talking about eliminating that step up in basis on death. So as I talked about death beating taxes, well, in this case, death would not be taxes. Okay, they would eliminate the step up in basis. And so if you died, your estate would still have to pay capital gain taxes if they sold your property. They're also talking about raising the estate tax, which is not that important to most people, but the rate would raise from 40% to 45%, and they would reduce the exemption from 11.58 million to only 3.5 million. So this would apply to 0.59% of all estates as opposed to the current 0.09%. Okay, so it's not going to affect most of us, but hopefully we all get to the point where we have over 11 or $3.5 million of gain. I hope that my estate pays a lot of estate taxes when I pass away. But right now, it doesn't look like that's going to happen. Okay, so how can we prepare for this? Well, the current administration has expressed an intention as part of its tax plan to decrease the individual exemption and increase the top tax rate. So what can we do? Well, you should review your estate plan if you are a high income earner. Make sure you're taking advantage of current tax savings. Be sure to have your estate planning documents drafted in a way that they're flexible for an uncertain future. Keep attending seminars on these topics as these issues progress. For 1031 exchanges, I ask that you lobby. If you go to 1031taxreform.com, there's a tool there where you can lobby your state and your federal legislators, rather, and tell them you want them to leave 1031 exchanges alone. It's a one-step tool. You don't have to write anything. You just basically click. I think you put in your zip code and your name, and basically it sends out an email on your behalf. It's important to remember we've been down this road before. In the past, Congress has looked at 1031 exchanges. It's important to note this is not just a Democratic issue. The Republicans in 2017, when they passed the Tax Cut and Jobs Act, initially they proposed eliminating 1031 exchanges. That was the Republicans, okay? Ultimately, they left 1031 exchanges alone for real estate, but they did eliminate them for personal property. So we used to do exchanges of aircraft. We used to do exchanges of collectible artwork. We used to do exchanges of business equipment. We can no longer do that since 2017, or actually it was effective 2018. Also, Obama's budget proposed limiting 1031 exchanges to under 1 million. Okay. And as I said, the Tax Cut and Jobs Act also, had its issues as well. So we've fought this battle before and we will continue to fight it. I think there will be a compromise. I think 1031 will be left alone, or we may see something like the limits being set at $1 million, which I think would be a little bit more fair, though not great. Okay. What are the arguments for keeping 1031 exchanges? Well, they constitute 6 to 18% of all commercial real estate deals. It's a big segment of the market. The vast majority of 1031 exchanges also result ultimately in a taxable sale. So it does not really present a income generator for the federal government. And elimination could result in a reduction in property values, less revenue for state and local governments, less spending on construction and rehabilitation. And their estimates are that it could decrease gross domestic product by at least a percentage point, which is pretty hefty. So I think we'll see 1031 left alone and cooler heads will prevail. Any questions so far? Okay, guys.
One question. You have to be an American to do the voting thing on the 1031 exchange tax reform?
That's a good question. I think you can, if you are you in the United States?
Right now I am, yes.
If you put in a US zip code, they will accept it.
Awesome, thank you.
Okay.
Can you go back to your last slide, please?
Yeah, sure. And like I said, we will send the PowerPoint out as well.
Yeah. So my question is, why would elimination be less revenue? Because elimination would be more revenue, because they're basically saying that right now they're not collecting it, so then there would be more revenue.
Yeah, here's my point. I'm saying it's not as big a revenue generator as they think, because the vast majority, something like 88% of 1031 exchanges, ultimately lead to a taxable transaction. Okay, so you might do a 1031 exchange today, but when you sell that property in 5 years, you're going to pay your taxes unless you do another 1031 exchanges. And while we like to talk about swapping until you drop, right, and death beating taxes, the reality is 85% of the people that do exchanges do not take advantage of that, and they do in fact pay taxes. Okay, so they may initially get some additional revenue in the early years, but the reality is it does not result in any really long-term revenue and should level out and really not produce much. In addition, I believe that they will hurt the real estate economy. People who are facing these huge tax bills, especially if the rate goes up, just will not sell. And if they don't sell, there's no taxes, right? And if they don't sell, that means less revenue for state and local governments. There's no transfer taxes. There's no recording fees. So the state and local governments are going to get hurt. And then most of our clients who do 1031 exchanges, they spend a significant amount of money rehabbing those properties and constructing new properties. That's also not going to happen, right? And so then you're going to lose federal tax dollars there on the construction costs, and that's going to lead to a decrease in jobs. It's going to be less construction jobs, less real estate brokers earning commissions. I'll have to go get an honest job and do something instead of talking to you folks, about 1031 exchanges, so, you have all those issues. So that's why it's not that it will not produce any revenue. It just won't produce significant revenue. The federal government's own estimate, which is completely, I think, bogus, is that it would generate something like, I think they said $80 billion. Okay. Which is ridiculous. However, they are talking about a spending package between the American Jobs Plan and the American Families Plan of over $6 trillion, right? So they need $6 trillion. $80 billion is not going to do it, right? It's silly. They're focusing on the wrong thing. They're swatting at flies when, there's Godzilla, or I'm trying to think of it better. Who's a dinosaur that flies through the air? When there's pterodactyls flying through the air, and they're swatting at flies, so I think in the end they'll see that. I think also, I'm in New York, and so my Senator Chuck Schumer, who's the House Majority Leader, the Senate Majority Leader. People think that Chuck Schumer is this firebrand liberal. I live here. He's just not. He's a pro-business Democrat, and real estate is the heart of New York business. So I don't think you're going to see 1031 get hit. I could be wrong, but I'm optimistic. Did that answer your question?
Yep, I'm good. Thank you.
Good. Any other questions? Cool. I'm going to jump into 1031 exchanges and bore you further. Okay. So how do we get around this currently? Well, we're talking about Internal Revenue Code Section 1031, which provides that no gain or loss shall be recognized on the exchange of real property held for productive use in a trade business or for investment, if such real property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade business or for investment. Okay, quick quiz. What does that mean? Anyone? Bueller?
If you sell something, you have to buy something similar to avoid paying capital gains.
Exactly. To avoid paying taxes when you sell investment real estate, you have to trade it for other investment real estate. Okay, so this section is typical tax code mumbo jumbo. This is what it really means, right? You have to do a trade of one property for the other. What you cannot do is sell a property and take the money and then at some point go buy another property. That doesn't work. For tax purposes, you have to trade properties. Okay, so if Hutch had a property I liked and I had a property Hutch liked and we just traded deeds, well, that's automatically a 1031 exchange. And I'd have a nice property in San Diego and Hutch would be stuck here with Long Island winters. But that swap is automatically a 1031 exchange. And that's what the 1031 exchange is designed for, two parties trading properties. That never happens. And so they created a separate structure whereby you use an entity called a qualified intermediary. And that's what we do. And for tax purposes, what's going to happen is Hutch is going to give us his property. They're going to sell it. And then we're going to take the money from that sale. We're going to go buy a property from somebody else. And then we're going to give that property to Hutch so that Hutch, for tax purposes, has exchange with us. Okay. Now that's a very cumbersome transaction. If we did that, there'd be all sorts of double transfer fees and, there's some risk. And so the IRS has said that, okay, it's enough. We'll have this tax fiction. But what will really happen is all that has to happen is the money when Hutch sells has to come to us to hold until Hutch is ready to buy. So Hutch never touches the money. So for tax purposes, he's receiving property for property instead of selling and buying, which is taxable. Does that make sense? Okay. I'm not going to say it doesn't make sense because it really doesn't make sense, but is that clear? Okay. This is what it looks like. I'll talk about like-kind property. So we talk about like-kind property. What this means is that you have to basically buy some form of investment real estate. Okay. You can trade an office building for a factory for a farm for a multifamily apartment building, and a multifamily apartment building for a bunch of single-family residential rental properties. All those are deemed to be like-kind for 1031 purposes. They're very, very different properties, but for our purposes, they are quote-unquote investment property and can be exchanged back and forth. Some other things that are real property, you may have heard about Delaware statutory trust and tenant in common interest. New York, actually now it's all cooperative apartments. I don't know if they have cooperative apartments where you are, but they are like-kind. Development rights such as air rights, easements, oil, gas, and mineral rights, cell phone tower easements we've done as well. Okay, so you can kind of be a little bit creative when you're talking about what is real property. Types of exchanges, well, we have the delayed exchange. This is where you sell first and then buy. The way this works is the exchanger, before they do anything, they contact us to set up their exchange, because if they just sell and then decide to do a 1031 exchange, well, it's too late. They're going to pay taxes. So they contact us. We set up the exchange. When they're ready to go to closing, they sign all of our documents, and then they will deed the property to their buyer. The buyer pays us. They then have 45 days to identify their replacement property and up to 180 days from the closing of the sale to close on it. When they find that property, they will go to contract like they normally do. When they're ready to go to closing, we take assignment of that contract and we spend the money, and the taxpayer, the exchanger, receives the property directly in exchange for what they sold. Make sense? Great. Now let's make it complicated. So we have these deadlines: 45 days to identify the replacement property, and the earlier of the tax filing due date, or 180 days to close. That typically means you have 180 days to close from your sale. These dates are calendar dates, includes weekends and holidays. There are no extensions. Okay, so unlike a lot of other things in taxes, these are hard, fast dates, with the exception of the IRS has in the past extended the deadline where the property or the taxpayer was affected by a federally declared natural disaster. Okay, so things like here on the East Coast, we had Superstorm Sandy a couple of years ago. You folks in California, you have all kinds of things, right? You've had earthquakes, you've had mudslides, you've had wildfires. People in the middle of the country have faced blizzards, tornadoes. These are all reasons why the federal government has extended these dates in the past. COVID-19 was another reason that there are no more extensions for COVID-19, but they did give extensions when the pandemic hit. I'm going to kind of go through this pretty quickly, but basically this just says that the identification has to be in writing. The way this works is we send you a form, you fill it out with properties, and you send it back to us signed and dated within the 45 days. Usually a scanned email is what we get, the PDF. Okay, you're limited. You can identify multiple properties, but there are limitations. So if you only identify 3 properties, you can identify as much value as you want. 3 properties, you can exceed infinity of value, if that's possible. I guess Buzz Lightyear thought it was possible, right? Infinity and beyond. But you can identify 3 properties of infinity and beyond, and it doesn't matter. If you identify more than 3 properties, then you're limited to identifying double the value of what you sold. So if you sold for $450,000 and you identify 5 properties, you are limited to $900,000 total of property. You can violate that rule, but if you do, you have to buy 95% of what you identified. This should say 95% rule. It's a typo. So if you identify, in this case, 8 properties, I'm sorry, it's 4 properties in this case, and you exceed 200% of the value, then you have to buy 95% of what you identified. By way of example, you sold for $450,000. You identified 4 properties worth $1 million. That's more than double 450. That's okay as long as you buy $950,000 of the property you identified. Okay. Don't worry too much about that. There's just a little bit of nuance. Just know that if you were doing a 1031 exchange, there is the option to identify multiple properties, but you have to be careful. Any questions on the forward exchange?
Mike?
Yeah.
Quick question.
Yeah.
So if I were to, so if I had a property and I sold, I can identify, if I want to put it in like 4 different properties, I can do that, but the value has to be more than, I guess, double what I sold, correct?
It does not have to be. So you can absolutely take your equity and spread it out amongst multiple properties.
Okay.
You have to basically spend, we'll get to this in a slide later, to fully defer your taxes, you're going to want to spend at least as much as you sold for, right?
Okay.
And spend all the proceeds. So this only applies to identification. It's kind of a silly requirement. It's just a little bit of a nuance, but basically you could buy as much property as you want in a 1031 exchange. You just have to be careful when you identify that you fall within those rules. Okay. And you always have that 95% rule where as long as you buy most of what you identify, 95%, you're good to go.
Now, if, again, I don't want to hold up too much, but if I sold, let's say I sold a property for $1 million, and I want to enroll it to another property. Does it have to, it can't be something lower than $1 million. It has to be more than $1 million, correct?
It can be less, but you'll pay tax on the difference. And I'm going to
I have
a good slide on this, which we'll talk about.
Perfect.
Hey, just Mike, a quick question or clarification. If I'm buying a portfolio of properties from the seller, same seller, they're on different property tax IDs, but the same seller, same loan, that counts as different properties, correct?
Yeah, that's the safe answer. Is that if let's say you're buying 10 properties from the same seller, it's a portfolio. I think there is some disagreement in the industry on this, and the IRS has not answered it. But basically, I think if you're buying from the same seller and they're contiguous, I think you have a good argument that they could constitute one property, right? So if they're all next to each other, you're buying an apartment complex, for instance, with multiple buildings, but they're all in like one complex, I think that can count as one property. If you're buying a portfolio that's scattered all over the country, I think you have to treat that as separate properties.
Now, this is sort of follow on. If I identify the portfolio during negotiations, after the 45 days, I'm doing a close, I negotiate the price to 90% of its original value. I'm still buying everything that I identified, but I'm now 90% instead of 95. Is that going to be a hard thing or?
That it's not an issue at all, because again, it's the fair market value at the time you identify, and you're buying everything. So you're buying 90. I understand what you're. The point is, here's where let me show you where you would fall into problems. So you identified 10 properties worth $1 million. You sold for 450, and you only buy 8 out of those 10 properties. Let's say. That's where you would fall into, trouble, because you'd only be at 80, let's say 80% of the value.
All right,
but yeah, if you got it all, you'd be all right.
Yeah.
Good question. Any other questions? Yeah, go ahead, Michael.
I came in late and I did overhear. What would be the reason for them to get rid of the 1031 exchange? If you said like it could affect like local government or stuff like that, what would be in their benefit to get rid of this?
I think it's ignorance, quite frankly. I think there's a perception, and it's been fed. I'm not a person to blame the media. I don't believe in what do they call it, the mainstream media or any of that stuff. But I think between the media and I think some politicians also, I think there's a perception that this is a rich person's tool. That only the highest income people do this, and and that $400,000 is a lot of money when it comes to buying and selling property. And it's just not true. Most mom and pops, can make well over that. And it may be their retirement savings. My perfect example is my grandparents moved here from Europe in the 50s, and they bought a 6-family, apartment building in Ridgewood, Queens, and granted, by the time they passed away, they weren't seeing, $1 million of gain, but they bought it for next to nothing. And when they passed away, it sold for $600,000. So that was a $600,000 gain, right? Essentially. And, I can tell you, my grandparents were not wealthy people. They were wealthy in other ways. They had 8 children who took very good care of them. But, they were not jet setters. My grandfather wasn't wearing a Rolex. These were working class people. My grandfather was a bricklayer his entire life till he retired. So I think they think, and they also think that it's going to generate far more revenue than it really would. And studies have shown that. And so it's just a matter of educating them. It's something that comes up periodically in both sides of the aisle. And we just always have to kind of go back to basics and teach them what we actually do.
Yeah. I mean, again, I just don't think it'll go away, but I just didn't know if there was really a real reason, but again, I just wanted to ask. Yeah,
it's money. It all comes down. And if you missed it, you can go to 1031taxreform.com and you can basically do there's a tool there. You just basically put in your name and zip code, and you can lobby your representatives to tell them to leave 1031 exchanges alone.
Thank you.
Yep. Okay, let me talk about reverse exchanges. So we talked about forward exchanges. We can also do this backwards. So we can buy before we sell. The structure is much more complex. It's not for the faint of heart. But basically what happens is we will buy one of the 2 properties. We, meaning Madison Exchange. As a result, the fee is much higher. Give you an idea, your typical standard forward exchange is between $1,000 and $2,000. Typically, to do a reverse exchange, prices start at about $8,000. So this is not for somebody who's making $10,000 of gain. This is for a higher property. So the way this works is this is where we park the replacement property, which is most typical. The exchanger will lend us money. Okay, we set up an LLC. They loan the LLC money. We can also use third-party financing, so we will be the borrower on the loan as well. And we will spend that money and buy a property from the seller who gives us title to the property. We then enter into a lease with the exchanger so that the exchanger has all the benefits of the property during the exchange period. They have 45 days then to identify what they're selling in this case, and 180 days to actually close on that sale. When they're ready to close, now it's a forward exchange. The exchanger deeds the property to the buyer. The buyer pays us like they did in a forward exchange. We then take that money. Well, first we then deed the replacement property to the exchanger. And with the cash we receive, we repay the exchanger for the funds that they advanced for the acquisition of the replacement property, completing the exchange. So the taxpayer is getting the money from their sale, but it's not taxable because it is characterized as the repayment of a loan, which is not taxable. Okay. This is a lot to throw at you in a very short period of time. Just know that it is possible to buy first and then sell. That's the most important thing. We can also use this same structure to use tax money to make improvements to the property. Okay. So the exchanger is in a forward exchange. They sell to their buyer. The buyer pays $1 million for that property. They pay it to us as the qualified intermediary. Now they have 45 days to identify, 180 days to close. The exchanger finds a property, but it's worth less than $1 million, but they plan to add a lot of value to it very, very quickly. So the exchanger then has us buy the property from the seller, the 1031 money. The seller deeds the property to us. We then enter into a construction agreement with the taxpayer. And during the remainder of the 180 days, we paid $700,000 for the property. During the remainder of the 180 days, we'll spend the remaining $3 to make improvements. And then when the 180 days is up, we transfer the property to the taxpayer at the improved value of $1 million, allowing them to complete their exchange. Okay, so we can do this as well. Now notice, 180 days, you're probably thinking, doesn't give you much time to do construction, right? So doing ground up construction in an improvement exchange is very, very difficult. But what if you bought this property for $700,000 as vacant land, and it's going to be a much larger project? It's going to be, let's say, a $5 million project. And in 180 days, all you need, and I have a client doing this now, in 180 days, you can get your architectural drawings done. You can do your site planning. You could do your excavation, and maybe you can pour your foundation. And that eats up $300,000. And that gets you to your fully deferred exchange, because you get to $1 million. Okay. Ken, did you have a question? It looked like you came off mute.
So the qualified emitter, the QI is the one actually paying for the construction. And so
Correct.
even if the buyer arranges for it, it's sort of like a 2 or 3 loan or something like that, where he can't pay for it directly. He has to, arrange for it, but the actual invoices go to the QI.
Correct. Yeah. And then we just make progress payments. And what we've actually done in the past too is we'll often, so we go back to here, we've entered into a construction agreement with the taxpayer. We can, usually what the taxpayer will do is they'll set up a shell entity to do the construction management. And so we could technically pay to a shell entity construction manager who then makes the payments. That sometimes is easier than us paying the contractor directly. But you want those to be legit costs, because if you get audited, it would be disallowed. Any other questions?
Hey, Michael, I have one.
Yeah.
I'm sorry about that. You just switched slide.
No worries. No worries.
I guess let's just hypothetically say if you're selling a property under one entity, and then you're purchasing a property under another entity, how would you be able to avoid any tax consequences from that?
Yes, that's a good question. So essentially and this is, part of a much longer presentation, but I can cover pretty quickly. The essentials of doing a 1031 exchange, right? So this is a tax thing, right? Which means that the taxpayer that sells the relinquished property has to be the same taxpayer that buys the replacement property. And if you think about it logically, it has to be, because how else would you file this on a tax return if there were 2 taxpayers involved? So it has to be the same taxpayer. So you can sell in one entity and buy in another if it is what's called a disregarded entity. And a disregarded entity is usually a single member limited liability company. So, Samson, if you were the sole member of an LLC, Samson LLC, and you sold in that entity, you might want to buy your replacement property in the Samson 2 LLC, right? And so you can do that, but you just have to be the sole member of that, and everything has to flow to your individual tax return. Does that make sense?
Yes, no, definitely. Got it. Thank you.
And we see that a lot, because a lot of our clients, they're not too creative, right? When they set up an LLC to buy their property, it's going to be the 123 Main Street LLC, right? They usually name the property after the street address, which just makes life easier when you're trying to, keep records. And so they can sell in the 123 LLC if it's a single member LLC, and then they can buy the 456 Oak Plaza LLC, as long as they're the sole member of that entity also.
Got it. What if it's a husband and wife that's owner of it?
Yeah.
It still comes back to the same tax returns though, right?
It depends. Okay. So if you are in a community property state, so California is a community property state. I forget all of them, but California is one. If you're in a community property state, a husband and wife LLC is treated as a disregarded entity, which makes perfectly logical sense. It's going to their joint tax return. If you are not in a community property state, which is virtually almost every state with the exception of like 6 or 7, a husband and wife LLC, believe it or not, is treated as a partnership for tax purposes. And so so if you're selling as a husband and wife, you would have to then, if you wanted LLC protection, believe it or not, you'd have to buy in 2 LLCs, the husband's LLC and the wife's LLC, which is absolutely ridiculous. And likewise, what I would do if you had a husband and wife in one LLC, you wanted to buy in a different LLC, I would just make the old LLC the sole member of the new one. Right. So the 123 LLC would be the sole member of the 456 Oak Street LLC. And that makes it a disregarded entity to the partnership. That makes
Got
sense. Again, I'm not
Yeah,
gonna
no,
say,
got it. And
Yeah.
so instead of the individual taking over the LLC, it'll just be the first LLC taking over the second.
correct. Yeah. So I'm not going to ask if it makes sense because it doesn't make sense, but if I just want to make sure it's understandable.
No, got it. Thank you, Michael.
You're welcome. Any other questions?
Do you have a slide that covers how this works inside of a syndication?
I actually don't. That was the one thing I didn't put in, but I can explain it.
Yes, I think this would be a perfect opportunity to talk about that.
Yeah. So we talk about syndications, right? And so I'm just going to define terms a little bit. When I talk about a syndication, what I'm referring to is basically a joint investment of several individuals under one limited liability company. It's usually structured as a limited partnership. And so you have a syndicator, and the syndicator, she might be the person that raised all the money. She found the property. She got all the investors together. She typically is going to have equity in the deal, but the equity probably is a little bit greater than what her dollar investment is in the deal, right? So she is not only putting in cash, but she's putting in sweat equity, which is going to give her an outsized portion of the deal. The rest of the partners in the LLC will be limited partners. They will not have decision-making ability. They're basically along for the ride. They're just putting up capital. So there's two questions. Number one, can we bring 1031 money into a syndication? And the answer is not really, but there's a workaround. Okay, so the problem I was just talking to Samson about is the same issue. So basically, if you sell as an individual, you have to buy as an individual. Okay, that means you have to buy a deeded interest in a property. You cannot take your 1031 money and put it into a syndicated entity because you're not buying property then, you're buying a partnership interest, which is not like kind to what you sold. Okay, it's not real estate. So the way you do this is you set up two entities as the syndicator. So the syndicator will set up her syndicated entity with all of her regular money and regular investors, and she will set up a separate liability company, limited liability company, for her one 1031 investor, who then will buy separately as a tenant in common with the syndicated entity. So there will be two owners of the property, the 1031 investor and the syndicated entity. Okay. That creates complications for the syndicator because where she might earn outsized returns compared to everybody else, the 1031 investor, if he's putting in a quarter of the equity, he's got to get a quarter of the interest in the property. Okay, so there's no room for the syndicator for her sweat equity as far as his interest goes. Now, she can still have a management agreement for the property and earn management fees. She can earn a commission when she sells the property. But some of the other things that we do, like waterfalls and all that other stuff, becomes complicated. So usually we suggest that you stay in that structure for 2 years. And then if the property is going to be a long-term hold, you would wrap it in after that once the exchange is quote unquote old and cold, and the IRS and the states are probably less interested in looking at them. Does that make sense? Okay.
That was like a labyrinth, though.
It is a little bit like a labyrinth. Yeah.
I followed halfway, but thank you.
Yeah, and what I'll do, I will make it a point when I send the PowerPoint out to Hutch. I'll send you a redrafted PowerPoint, Hutch, and I'll send you with slides on syndication. Okay.
Perfect.
Okay, and if folks have questions, you can always give me a call. I spend a good portion of my day answering questions about 1031s and syndication specifically. Okay, the other problem we have is, okay, so now we're all together. We're in the syndicate. We're all happy. Property's being sold. Great. Some of us want to do a 1031 exchange. Great. Some of us don't. Oh, that's a problem. Okay. Because again, the syndicated entity can sell the property and do a 1031 exchange and buy a replacement property. But if people want out, it becomes difficult. And the reason is, let's say we sold for $1 million and we have 10 investors, each has $100,000 interest in the property. When we then buy, if we only buy for $800,000 because two people want out, the problem is that $200,000 is gain that's recognized by the partnership, and the tax is going to be paid by all 10 of us rather than the two that are cashing out. So typically what we do is we have to get those people out of the LLC beforehand. We do something called the drop and swap. So the LLC will deed a tenant in common interest to those two investors. They'll be out of the LLC. They'll have a property interest. And then the three of us, the LLC and those two other people, will sell to the buyer, and the syndicated entity will do the 1031 exchange, and those two people will take their cash and they'll go pay their taxes. Okay, that's the drop and swap. So again, there's a lot there with both of these things. The most important thing I can suggest is you allow adequate time to plan, right? Don't do this on the eve of closing. I deal with too many of those phone calls. I get grouchy when that happens. When people call me on the eve of closing and they want to do this advanced structuring. So give us some notice. Usually, I won't say always, but there may be a workaround provided we have time on our side. Make sense? Was it? I don't know if any of you are old enough to remember the old Hulk show with Bill Bixby. His tagline was like, "Don't make me angry. You wouldn't like me when I'm angry." And then he turns into the Hulk and all hell breaks loose. That's me, basically.
It's not that old.
Okay, good. Glad to hear that. Okay, I think I just have one more point, and then I'll let you go about your evening. So we were talking about tax deferral before. So this is how we achieve full tax deferral. So basically, there's two rules of thumb to do that. You have to buy property that's equal or greater in value to what you're selling, and you have to spend all the money from the sale. Okay, so if you sold for $10 million and you paid off a mortgage of $3 million and you had closing costs of $900,000, that would leave you with net equity of $6.1 million. Okay, if you buy a property for 15 million and you spend the full 6.1 million of equity as your down payment, you'll take on new debt of 8.9 million. You'll have no what we call boot in the exchange, and boot is non-like-kind property. I'm not sure where the term comes from. I was told that it comes from pirate booty, meaning that the plunder that you wind up with. Somebody told me that is poppycock. My colleague, actually, he has a different theory, something about horses and bridles and things like that. And I was never able to follow it. So just know that boot is usually going to be either cash that you don't spend or mortgage debt that you don't replace. Okay. As opposed to this exchange, we went from 10 million to 8 million. In this case, we spent only 5 million of our 6.5 million of equity. And so we were left with $1.5 million. That is boot. We will pay tax on up to $1.5 million in that case. So again, it's not that you cannot do it. You just want to make sure it makes sense. So if your gain is less than $1.5 million, then this transaction doesn't make sense because you won't save any money. And here's another circumstance. So we bought the same property. In this case, we spent all of our equity, but we reduced our debt from 3 million to 1.5. So we have $1.5 million of mortgage relief that is subject to taxes. Now, can somebody tell me why this is worse than this?
Because it's taxes regular income versus capital gains?
Nope, close. It's a little bit simpler than that. Here, we're going to pay taxes on $1.5 million, but we don't have $1.5 million to pay the taxes, right? Because there's no money here, right? We spent all the cash, right? So our mortgage relief is taxable, but we don't have any money to pay the taxes. So we have to break open the piggy bank. And hopefully it's a big piggy bank because the taxes on $1.5 million are probably going to be about $500,000. Make sense? Perfect. And that, I believe, is all I have. My information is on the screen. You can feel free to call me on my cell is usually the best place to reach me. And email is always good too. mbrady@madison1031.com.
All right. So I have one crazy question, right? For the $1.5 million that you have left over, could you roll it into another property?
Yes, absolutely. You can buy multiple properties. Absolutely.
Okay, good. Gotcha.
Hey, Mike, I have a quick question for you. I could do the other way. If I sell two properties, I could convert into one.
Correct.
But if my sale dates are different on the sale, my 45-day clock starts on the sale of the first one, correct?
Correct. And usually I would set you up in 2 exchanges to give you the flexibility of having both deadlines. So in case you ran out of time, at least you'd be able to salvage one of the 2 exchanges, by having a fresh clock. But
Okay.
yes, to combine them, you'd be stuck on the clock of the first one.
So when would I have to decide if I wanted to combine them? When you said 2 different exchanges, can I combine those exchanges into one
Yes.
property?
Yep, absolutely.
Okay. Now,
Yeah,
what if the second one sales after 45 days?
You can still do it, so you can combine them. Essentially, you're going to buy the same property in both exchanges. So it's still doable. You can still do that.
Okay.
Only, where it comes into problem, if you have 2 properties and they're each owned in different taxpayers, that's where it becomes problematic. Because let's say, you own one property individually, you own the second property with a partner. Now you have 2 different exchanges. And now in each exchange, you're going to have to identify the percentage that you're buying in each exchange. It's a little bit of a pain in the neck. It's not undoable, but it's another level of complexity. Okay. As opposed to if it's just you, you don't have to identify the percentage because you're buying 100% of the property.
Okay. And both exchanges can go into the same, if I own the properties individually, but my target LLC is like a disregarded entity LLC.
Yeah.
That should be fine.
Okay. You can
Okay.
do one LLC, absolutely. Yep.
Question: Do you are you able to, and do you do deals across the country, or are you limited to certain states?
Yeah.
How does that work?
Yeah, so we do all 50 states. So we work with, first of all, we're part of a national title insurance company that deals in all 50 states. But even if we're not doing the title, we work with all title companies across the country. We've done exchanges everywhere from, I don't think I've ever done one in Alaska, but it just hasn't come my way. But let's say at least Washington to the tip of Florida. We'll cover the country that way.
Thank you.
Alrighty. Some great questions, man. Appreciate y'all sticking around. There we go. Yes, it's always great information. Chatting with you, Mike. Appreciate you.
Yeah. Thanks for having me. It was nice talking to all you.
Yeah. What other service does Madison provides?
Yeah. So we also provide title insurance nationwide. We are one of, if not the largest, independently owned title insurance agent in the country. We underwrite with all the big underwriters, such as First American, Stewart. Who else is out there? Old Republic. All the big title insurance companies. And we insure several $1 billion of transactions every year. We also do cost segregation services. You may know from LinkedIn, you may know my colleague Yona Weiss, who's the cost seg king. Yona is one of our many cost seg guys, but one of our most visible for sure. And we do lease abstracting and due diligence from a company. It's not a great name for a company, but it's it's Lease Pro Real Diligence. So we do lease abstracting and financial due diligence for real estate investors and owners.
Can you explain the last one a little bit?
Yeah, so let's say you're going to buy a big multi-family. Well, it's usually more like a commercial, let's say an office building. Let's say you were buying an office building with 50 leases. To basically do your due diligence and read 50 leases is going to take you a very, very long time. If you have a law firm, it's going to take them a very long time and a lot of billable hours. So what we do, we actually will take those leases, we send them off. We have actually a back office in Israel, and our team there they're trained to digest the leases, and they will print out a report giving you all the essential terms of the leases, usually in a very short period of time. I was saying 24 hours at one point. It's gotten a little bit tighter just because we've been very, very busy, but very, very quickly and very, very economically. Let's say, this isn't a direct quote, but we're talking about, a few $100s per lease, maybe $300 to $500 per lease.
Oh, nice. So I think you touched on it briefly earlier as far as the cost of the services. What is the typical cost of a 1031 exchange?
Yeah, so typically the proceeds, our fees, and this varies industry wide, but our fees are $1,000 for a transaction where there's under $2 million of proceeds. If the proceeds are over $2 million, we have to do we have to set up special bank accounts. And so we actually charge a fee of $1,750 for that exchange. And to do a reverse exchange, they quote it on a case by case basis in reverse and improvement exchanges, and they start at about $8,000.
Okay, so of course, all that stuff would have to be weighed into the taxes that we would be paying, right? So that makes sense. Is that something that you do on a consultant call, saying, "Here's my situation," and you talk about what it would cost and what makes sense before actually?
Yeah, I kind of do. There's no magic number. I get asked a lot, what's the minimum amount of gain that I can have in order to make sense? And really, I've had people that'll do it on. I've had somebody do it on $15,000 a gain. The tax bill was going to be about $3,000, and they said, "I'd rather give you $1,000 and keep the 2,000, and keep the 2,000 because I don't want to pay taxes." I think that's extreme. If it were me, I'd probably just pay the taxes rather than deal with those headaches of the deadlines. But typically, the lowest we usually see is $50,000 a gain or so. It starts to really make sense, I think, at $1,000. I'm sorry, $100,000 a gain. But yeah, between 50 and 100 is, I'd say, the minimum. And then, of course, obviously, we've done exchanges where there's been hundreds of $1,000,000 of gain as well.
Okay, got you. So I'm paying that a couple $1,000s for the services to save taxes. Can I write off that expense?
Yeah, our fee actually will reduce your taxable gain. So yeah.
Okay, got you. All right, that's all my questions. Any more questions from the panel?
Yeah.
All right, man. So we got it for about
One
the
question.
20th.
Sorry.
Yeah, perfect.
Thank you. So you said you're gonna turn into a Hulk if we ask really late. What is when we're ready to ask you? And let's say I have a friend and he put a property under con today, and he would like to talk to you about this situation.
Well, that's not a problem. Yeah, that's not a problem.
Awesome.
Where I turn into the Hulk, is where you call me, you say, "Mike, I have a friend. He's sitting at the closing table signing papers." And even then,
Okay.
I'm actually relatively calm. What actually happens is
No,
I
I'm
call
just
the
kidding.
I call the back office, and they turn into the Hulk.
Thank you. Okay, so I sent to you on LinkedIn and definitely
Okay,
want
cool.
to figure out if this is going to be worth it or if it's too small of a property or how to set it up so that it's prepared for our 1031 because it's a stepping stone.
Okay, perfect. We'll talk. Absolutely. Look forward to it.
Yeah, tight. So we have a small group where we can stick around here and we can do some networking here, right? Instead of doing the breakouts in the rooms, we got an expert there. We can continue to ask questions. Michael, greatly appreciate you doing a presentation for us. We usually go into breakout rooms, but I think we're going to stick around in this small group and just continue.
Okay, yeah,
conversation.
I actually have to jump off. But I appreciate everything. And yeah, like I said, guys, give me a call. Any questions? I'm more than happy to answer anytime. Oh, and we have Alana. I'm saying guys. My apologies.
Yeah. All right,
All right, folks. Good night, folks.